Welcome to Fund to Money, your 24/7 buddy on all matters related to personal finance. Now, in this particular web series, we are discussing all the important things that you need to know while investing in stocks. Right now, we are sticking on to, in this particular segment, is going to stick on to the big picture, the big, larger things that actually go on to impact your stock market investments, potential or existing investments. And right now, in this particular segment, we are going to discuss the role interest rates have to play. That's coming up shortly. Well, interest rates are not just important for fixed deposits, which you would probably invest in a bank fixed deposit or any other company fixed deposit, or your loans. They actually, yeah, they really impact your stock market investments as well. How? Well, to give you the answer, we have with our stock market expert Mohit Satyanand. Hi, Mohit.
Hi, Udayan.
Mohit, normally a person would associate interest rates with things like a loan or a home loan or car loan or any other kind of a retail kind of a loan, or say a fixed deposit. How does it enter into stock market or stocks investing?
Well, primarily two ways. The first is that we all have a limited amount of money to invest, and you can think of various places into which to put that money. So if you're looking at interest rate is a way of signaling the price of money or the opportunity cost of that money, meaning that let's say I have only two options as to what to do with my money. One is to put it in the bank and earn an interest rate via a fixed deposit, and the other is to put it in the stock markets. Now, obviously, the higher the interest rate that a bank is giving, the more attractive that's going to be, and relatively the less attractive it's going to be for me to invest in stocks. So, broadly speaking, though the connection is not so tight or so sharp, the higher interest rates are, the less attractive stock markets are. But it's not a very tight connection. The other is via the cost of funds for a company. So most companies are net borrowers. They borrow money from banks or other financial institutions in order to run their operations. And the cost of that borrowing is interest rate. And obviously when they pay that money out, that becomes a cost to the company, and it reduces profits. So the higher interest rates are, all other things remaining equal, which of course they never do, the lower the profits of the company. So again, broadly speaking, if interest rates are lower, companies can make somewhat higher profits. And therefore, in general, you could say that higher interest rates are bad for the stock markets from both these perspectives, the opportunity cost of your money as well as the profitability of companies. And lower interest rates are good. But it's not actually as simple as that. And if I were to be asked a question, are interest rates a very important determinant of whether one should invest in stock markets or not, I would tend towards saying not very important.
Mohit, you do the marathon, I can't even run a kilometer. But are there certain stocks which tend to be a little more vulnerable, more impacted by what's going on in terms of interest rates?
Yes, there are what we call interest rate sensitive stocks. The irony, of course, is that they become much more sensitive to interest rates after a boom period.
Okay.
Okay, so they go through a period when they think the interest rate is not so important, the economy is expanding so fast that a little bit of extra cost of borrowing doesn't matter, so they keep growing. And then there's a bust after the boom. This we've seen time and time again. We saw it in 2007, 2008. And now suddenly the cost of servicing their loans becomes a larger and larger and larger percentage of their earnings. And earnings are not going up because they're not making any fresh investments. There's too much capacity in the economy, whether it's of power or of real estate or of other infrastructure. And so now, how do they increase their profitability, or how do they reduce their losses? Often we're talking about reduction of losses, not an increase in profitability. The only way is that the cost of their borrowing goes down. And then they become not just interest rate sensitive, but interest rate hypersensitive stocks. But I don't think you should be owning those stocks in the first place.
Well, that clarifies quite a few things. The most interesting thing, which in Mohit's parlance, and I would take a liberty of taking one step ahead, it's almost like companies which are very sensitive, it's almost like your pay remaining the same, but your EMI is going up, your loan installments going up. I really hope you found this useful. If you found this useful, please go and like this video. And of course, if you don't agree with us or you have a suggestion, there's a comments section below. Please go and put in your comments out there. Please don't forget to check the description section. The edited transcript of this discussion is right there. And of course, remain connected with us on all leading social media platforms.